currently pursuing MBA at Sri Venkateswara College of Engineering, Bangalore. I have an assignment on factor influencing on working capital and subject is financial management. What is working capital? Working capital is the difference between current asset and current liability. Working capital refers to the amount of money of business has available finance day-to-day operation. For example, paying bill and expenses, purchasing inventory and supplies, managing the account receivable and payable like that. Working capital is calculated by subtracting the company's current liability and current asset. Current asset, it means cash equivalents, account receivable, that means amount owned by the business, inventory and prepaid expenses, etc. Current liability, it includes account payables, short-term loans and accrued expenses, it may wages. Capital in organization management, it involves the strategies to optimize the balance between the current asset and current liability to ensure the business sufficient funds and operate the efficiency of the organization. Factor influencing our working capital. First one is nature of business. The nature of business significantly influences the working capital. It may inventory level, account receivable and payable, service-based business, and gross margins, supply chain complexity, like that. In the business, inventory level high inventory level or in retail manufacturing require the more working capital and finance to their inventory purchases. In this company, account receivable and payable companies with longer payment terms and slow customer payment need more working capital to cover operational activities and expenses. In the production cycle, business with longer production cycle like constructions, aerospace, it requires the more working capital to finance work the progresses. And seasonality. Business with the fluctuating the demand and agriculture, tourism and need to adjust the working capital according to the managed seasonal fluctuating. Like this, nature of the business influencing the capital. Then second one is business cycle. Business cycle have some phases. First one is expansion, second one is peaks, third one is contraction, fourth one is throw and recovery phase. In the expansion phase, increasing the sale and production leads to higher account of receivable and inventory level. It requiring the more capital. As it is growing, the demand may lead the longer payment terms, increasing the account and receivable of working capital. It needs the more working capital for the organization. As it is in the business peak phase, high demand and production level may lead to inventory buildup and increasing the working capital requirement. Business may experience cash flow challenges due to the demand, payments, or supply chain disruption. And third one is construction phase. In the construction phase, decreasing the sales and productivity lead to reducing the account receivable and inventory level, freeing up working capital. Cash flow management become a crucial and navigate the reduced sales and revenue. And fourth phase is of the organization is through phase. In this phase, low demand and production level result is reduced working capital requirement. As it is, business may need to maintain the minimum inventory level and focus the cash equivalent. And last one is recovery phase. In this phase, increasing the demand and production lead to growing the working capital requirement, and business may lead the financial new and inventory accounts receivable and capital expansion. And third one is production cycle. Production cycle, it measures the production of the organization. It's a cash conversion cycle. It helps the business understand how long to purchase and receive the inventory, it leading time of the organization, and selling and deliver the product from the manufacturing and to the finished goods, collect payment from the customers. In the production cycle concept, mm, it may affect on the working capital, like longer production cycle require the more inventory and increasing the working capital needs more work in progress with the business complex production process may need the more capital and the process program. Account receivable. Longer scale of the collection period increase the account receivable and requiring the more working capital. And cash flow timing of the business with the mismatching the cash flow and outflow of my needs and more working capital to the manage the cash flow timings. A shorter production cycle may generally require the less working capital while a longer requirement of working capital. It affects the management of the production cycle is crucial management and advocate working capital and levels. Fourth one is credit policy. Credit policy refers to the guidelines and procedure of the business established to the manage credit sale, account receivable and customer payment. A well-defined credit policy influencing the working capital in credit terms. It may long-term or short-term credit limits. Higher credit limits for the customers may lead the increased account receivable and working capital needs. Credit screening. Effective credit screening is reduce the bad debt and minimize the working capital debts. By regularly reviewing these, adjusting their credit policy, and the business can strike the balance between the sales growth and the strike management and working capital optimization. One is working inventory management. Inventory management refers to the process of systeming the user managing and controlling inventory, and that means inventory tracking, monitoring and stock location and movements. And economic order equity, that means EOQ, determining the optimum order quantity, and supply management, building the relationship between the suppliers, like that. By optimizing the inventory management, business can reduce the capital requirement, improve the cash flow, and enhance the overall supply chain efficiency. Sixth one is market condition. Market condition is refers to the external factor affecting the business and ability to operate and generate revenue. This condition can impact working capital in various ways. It may demand fluctuation or competition of the companies and organization. Economic trends, it may upswing and impact of the customer spending affecting the working capital. And regularity changes in the market, it changes in supply chains, pricing and working capital, etc. Global events such as natural disaster or political instability can be impact on supply chain and working capital. The inflation and deflation also affecting the working capital. One is seasonality. Seasonality is referred to the fluctuation in demand of the product and services occur the specific time or period. It may be according to the weather, agriculture, school season, or holiday season, like that. Um, as it is, inventory management business can adjust the inventory level meets seasonal demand. Cash flow management seasonal fluctuate the impact on cash flow and requiring the business management cash reserve carefully. And supply chain management seasonally fluctuation can impact on the supply chain logistic and cost. By understanding these, preparing for seasonality, businesses can optimize their capital management and maintain the competitive edge in the market. Eighth one is supply terms. Supplier terms refers to the condition and agreement between the business and its suppliers. It may be a payment terms, credit limit, discount terms, delivery terms, lead terms, like that. By affecting managing the supplier terms, business can reduce the working capital requirement and improve the cash flow and enhance the overall supply chain efficiency. The ninth one is operating efficiency. It refers to the ability of the business to maximize the production and minimizing the waste of the operation, resulting in reducing cost, improved productivity, enhance the customer satisfaction, and increasing the competitiveness. By achieving the operating efficiency, business can reduce the operating capital. Its growth rate. Suppose company growth rate is high, in that case, it requires the more working capital, finance increase in inventory levels, support expand operations, hire additional staff, fund marketing and advertising effort like that. In high growth rate can lead to increase the account receivable also account payable, higher inventory level as it is great cash inflow requirement. To manage the working capital efficiency during the high growth, monitoring the cash closely, considering the financing and factoring, explore the funding options such as equity or debt in financing. By, by managing the working capital, business can support their growth, maintaining the financial stability. External financing conditions. External financial conditions refers to the factors outside company control that impact the financial situation. It may economic trends or interest rate, inflation, currency, government policies, market condition, and global events. These all are maybe effect on the working capital management of the organization. To managing the working capital effectively responds external financial condition, monitor the economic trends and adjust the strategies according to the trends and adjust the pricing and inventory level in the response inflations, maintaining a cash reserve and ensure the liquidity. By understanding and adapting to external finance condition, business can optimize their working capital management and maintain the finance stability. And the 12th one is economic factor. Economic factor that means the inflation, interest rate, GDP growth, exchange rate, trade policies, and commodity price and monetary policies. These are all factors directly or indirectly effect on the working capital of the organization. And the last one is management strategy. It refers to the plan and decide maybe company's leadership to achieve the goal and objectives. Well-defined management strategy can be impact on the working capital also. Cash flow management priorities. The cash flow management can lead the optimized capital levels. Account receivable and payable management. Aggressive collection of the policies and negotiate payment terms it improve the working capital. Supply chain optimization. Steaming the supply chain can reduce the inventory level and improve the working capital. Performance metrics. Monitoring the key performance of can help to identify the area of capital improvement. Risk management. Identifying and mitigating the risk can reduce the need for working capital buffers. Like this, improve the cash flow and reduce the capital requirement of the company and increasing the efficiency of the work and enhancing the competitive and support the growth initiative to the organization. It effectively management strategy and working capital management are interdependent and optimizing one can lead the improvement in the other. Here I conclude this topic. The effective working capital management requires the deep understanding of these factors of interrelationship as well as the ability of adapt the changing the and adapt the carefully balancing of these factors and maintaining the optimal level of the working capital. Business can ensure liquidity and reduce risk and long-term success. Working capital is a crucial component of company's health and its management, influenced by the company's other factors. These factors include the sales growth, inventory level, account receivable and payable, cash flow, industry trend and economic condition, and financial policies interact and ways and impact the company's working capital needs. Thank you for watching this video.